thinking about moving abroad, but still keeping that UK income going. Lots of people are in that boat. Today's discussion, which has actually been arranged for us by the brilliant folks at My Tax Accountant. You know, the top accounting firm here in the UK is all about the tax side of that exact situation.
Yeah, it can feel a bit daunting, can it?
It really can. Like wrestling with tax codes while juggling packing boxes. But hopefully we can bring some clarity today.
Absolutely. Understanding how HMRC sees your income once you've, physically left the UK is just fundamental. So, yeah, let's break down the main things people need to know based on the latest official info.
Okay, so where's the starting point in all this? It seems like everything really hangs on one thing: your residency status.
That's spot on. It all comes down to whether the UK considers you a resident for tax purposes. And they use something called the Statutory Residence Test, the SRT, to figure that out.
SRT.
Right.
Right. And that basically decides if you pay UK tax on just your UK earnings or everything.
Exactly. If you're a UK resident, you're generally taxed on your worldwide income. If you're a non-resident, it's usually just income that comes from the UK.
And it's not as simple as just like counting the days you're physically out of the UK, is it? Sounds more involved.
It is, yeah. The SRT has 3 layers to it. First up are the automatic overseas tests.
Yep.
If you meet one of those, bingo, you're generally classed as non-resident, and that's often it.
So what automatically makes you non-resident? Give us an idea.
Well, it's mainly about spending very little time here. For instance, fewer than 16 days in the UK in a tax year if you're a resident before, or maybe fewer than 46 days if you haven't been resident recently.
16 or 46 days.
Yeah.
Wow, okay, that's not much.
No. And there's also a test for people working full-time overseas. If you're doing that with very few UK work days and less than 91 days here overall, that usually makes you non-resident too. So it filters out people clearly based abroad first.
Right, got it. So what if you don't tick any of those automatic non-resident boxes? What's next?
Then HMRC looks at the flip side, the automatic UK tests. If you hit one of these, you're definitely a UK resident for tax. No arguments.
And the big one there is spending loads of time here.
That's the main one, yes. Spend 183 days or more in the UK in the tax year, and you are automatically a UK resident. Simple as that. Your worldwide income is then in scope for UK tax.
183 days. Okay, clear cut. Are there other automatic UK triggers?
Yeah, a couple more. Like, if your only home is in the UK for a period and you spend a decent amount of time actually in it, or if you work full-time in the UK for a whole year, those can also automatically make you resident.
Okay. So if you're not automatically overseas and you're not automatically UK,
Yeah.
you're in this middle ground. That's where the ties come in.
Exactly, the sufficient ties test. If your days in the UK fall somewhere between those automatic thresholds, HMRC then looks at your connections, your ties to the UK.
Ties. Like what kind of things count as ties?
Things like having close family here, spouse, partner, minor kids, having accommodation available to you, like a house or flat, having a job based in the UK. Also, things like spending more than 90 days here in either of the last 2 tax years, or even just spending more days in the UK than any other single country in that tax year.
It's not just having ties, it's how many you have compared to how many days you spend here.
Precisely. And it also matters if you're considered a leaver, someone who was UK resident recently, or an arriver. Leavers generally need fewer ties than arrivers to remain resident for the same number of days spent in the UK.
Ah, okay. So it's a bit tailored.
Yeah, it's quite nuanced. It means you really need to track your days and be aware of those connections.
Makes sense. And just quickly, the tax year itself, it runs April to April, right? Not the calendar year.
That's crucial, yes. 6th April to 5th April. So for 2025-26, it's 6th April 2025 to 5th April 2026. All these tests are based on that period. And honestly, for the real nitty-gritty on the SRT, the gov.uk site is the place to go.
Good tip. Okay, so we've established residency is paramount. Let's say we know our status. How does the UK actually tax the income? What are the rates and allowances for, say, 2025-26?
Right. Well, as things stand, and remember, they're frozen until 2028. The personal allowance, that's the bit you earn tax-free, is £12,570.
Okay, £12,570.
Then, income from £12,571 up to £50,270 is taxed at the basic rate, which is 20%.
20%.
Then you hit the higher rate band, 40%, on income between £50,271 and £125,140.
Right.
And anything over £125,140 falls into the additional rate, taxed at 45%.
So tiered rates. And that £12,570 tax-free bit, everyone gets that.
Not quite. If your total income creeps over £100,000, that personal allowance starts shrinking. It reduces by £1 for every £2 you earn above £100,000 K.
Oh, okay.
So by the time you're earning £125,140, you've lost it completely. All your income is taxable from the first pound.
And if you're still a UK resident, you've probably got national insurance on top of that too.
Yes, good point. UK residents working for UK employers will generally be paying national insurance contributions as well.
Now, what about our non-residents, the ones who've successfully moved abroad according to the SRT? Do they still get that £12,570 personal allowance on their UK income?
Usually, no. Most non-residents lose the UK personal allowance. There's an exception if you're a citizen of an EEA country or Switzerland, but even then, you often have to claim it back using Form R43.
So for most non-residents, their UK income, it just gets taxed straight away.
Pretty much. Typically, it's taxed at the basic rate, 20% from the first pound earned in the UK. But, and this is important, always check if there's a double taxation agreement, a DTA, between the UK and your new country. That can change things.
Right, those DTAs again. We'll come back to those. And people can check the latest bans on the HMRC website, I assume.
Definitely. Always best to check the official source for the current figures.
Okay, let's get specific. How does this work for different types of UK income? Say you move abroad, but you're still employed by your UK company working remotely.
Okay. Well, if you're still classed as a UK resident despite living abroad, your full salary is taxed in the UK, just like before.
Right.
But if you're definitely non-resident, you generally only pay UK income tax on the earnings for the days you physically work in the UK.
Ah, so it's prorated based on UK workdays?
Essentially, yes. And there's also something called split year treatment, which can apply in the year you move. It means you might be treated as resident for the part of the year before you left and non-resident after. It gets complicated, but it affects how that year's income is taxed.
Okay. What about other common UK income, like renting out a property you still own here?
Right, rental income for non-residents. That's usually handled through the non-resident landlord scheme. Your letting agent, or even your tenant, will typically deduct 20% tax from the rent before they even send it to you.
So taxes sorted at source, kind of?
Often, yes. But you can apply to HMRC to receive the rent gross without the tax taken off. If you do that, you then have to file a UK self-assessment tax return to declare the income and, importantly, claim any allowable expenses against it.
Got it. And things like pensions or dividends from the UK.
The UK state pension is usually paid gross, so no UK tax for non-residents. But private pensions and dividends? Well, they might still be subject to UK tax, even if you're non-resident. It really depends on the specifics and, again, whether a double taxation agreement changes the rules for that income type.
Okay, so the type of income matters a lot. Now, practically speaking, when someone actually makes the move, they need to tell HMRC, right? Our sources stress this.
Oh, absolutely vital. If you're leaving the UK permanently or you're going to work abroad full-time for at least one full tax year, that's April to April, you must let HMRC know.
Why is it so critical?
Well, firstly, it helps them get your tax coding right. It means they can work out if you're maybe due a tax refund for the year you leave. And it just avoids confusion and potential problems down the line if they don't know you've left.
So how do you do it? How do you tell them? Is there a form?
Yes, the main way, especially if you don't normally do a self-assessment tax return, is Form P85, leaving the UK getting your tax right.
P85.
If you leave a UK job and get a P45 form from your employer, you should send parts 2 and 3 of that P45 along with your P85. Even if you keep the same UK job but work remotely abroad, you still fill in the P85.
What if you're someone who does usually file a self-assessment return every year?
If you do self-assessment, you tell HMRC you've left via the residence section of the return, which is Supplementary Form SA-109. You normally have to send this by post.
So SA-109 instead of P85.
Well, technically, yes, but it's often still a good idea to send a P85 as well, especially if you're working full-time abroad for a UK employer. It helps prompt HMRC to sort out your tax code sooner rather than later. Better safe than sorry, really.
And not doing this, not filing the P85 or the SA-109, what happens?
It can cause real headaches. HMRC might not know your status has changed, so you could end up on an emergency tax code paying way too much tax initially. We saw that example of Morwenna, who moved to Oz, was late with her P85, and got hit with emergency tax. It just creates hassle you don't need when you're settling into a new country.
Definitely want to avoid that. So check gov.uk for the P85 details.
Exactly.
Okay. Now, you mentioned double taxation agreements, DTAs, a couple of times. Let's unpack those. What are they actually for?
DTAs are basically treaties, agreements between the UK and another country. Their main job is simple: to stop you being taxed on the same income twice, once here and once in your new country.
Makes sense. So how do they decide who gets to tax what?
They set out rules. For employment income, for example, the general rule in most DTAs is that the country where you physically do the work has the primary right to tax that income.
So if I live in France but work remotely for a UK firm, France taxes it mainly.
Usually, yes. But if you pop back to the UK for work meetings for, say, 30 days a year, the UK would likely have the right to tax the income earned during those 30 days. The DTA clarifies these rules.
What if, despite the DTA, both countries still somehow tax the same income? Can that happen?
It's less common, but possible in some scenarios. If it does happen, many DTAs have rules for tax credits. This means your home country, say, might give you a credit for the tax you've already paid in the other country on that same income.
Ah, so you get relief.
Yes, it offsets the double hit, like the example of Tegan in the Netherlands DTA there, could help offset UK tax if the income's already taxed over there. So, rule 1. Always check if a DTA exists between the UK and your new country. gov.uk has a full list.
Good advice. Okay, one last area. National insurance. If I move abroad but still have UK income, do I still need to pay NI contributions here?
Ah, yes, national insurance. It depends. It hinges on where you're going and for how long. If the country you move to has a social security agreement with the UK, many European countries do. For instance, you'll often continue paying NI in the UK, at least initially.
And you might need proof for the other country.
Exactly. You might need a certificate from HMRC to show the authorities there that you're covered by the UK system so you don't have to pay into their system too.
What if there isn't an agreement?
Then you'll probably have to pay social security contributions in that new country, according to their rules. However, there's also a UK rule that says you must pay UKNI for the first 52 weeks if your work abroad is temporary, your employer has a UK presence, and you were ordinarily resident here just before you left.
Right, so even if there's no agreement, you might still pay UKNI for the first year.
Potentially, yes, in that specific scenario. Your employer would usually deduct it via PNI as normal.
Is there ever a reason to pay UKNI if you don't have to, like voluntarily?
Yes, absolutely. You might be eligible to pay voluntary Class 2 or Class 3 NI contributions while you're abroad. People often do this to protect their UK state pension entitlement so they still get a full pension later on.
To keep the pension record ticking over.
Precisely. It can be really valuable. But important note, paying voluntary NI doesn't give you healthcare access in your new country. It's purely for benefits like the state pension. Again, gov.uk has all the info on eligibility and how to apply.
Wow, okay. That's covered a lot of ground, from residency tests to tax rates, telling HMRC, DTAs, and national insurance. It's clear there's quite a bit to get your head around.
There really is. It's definitely not simple. And getting it right involves understanding how all these different pieces fit together for your specific circumstances. And, the rules can change, so relying on current official guidance is key.
Absolutely. And while we've hopefully shed some light on the key areas today, everyone's situation is unique. For that truly tailored advice, specific to your move, your income, your destination, we really do suggest reaching out to the experts who made this discussion possible. My tax accountant.
Getting professional advice is often the best way to navigate this complexity and make sure you're compliant both here and in your new home.
Couldn't agree more. They can really help you plan properly and avoid any nasty surprises.